everyone. Um, this is last meeting of 2022. I know, thank you very much, everyone, for being here. I know we are all busy at the end of the year, so thank you, everyone. And we are going to start like mostly we always do. First, John Robinson is going to talk about cotton market. We will have also a market update from Mark Welch afterwards. And last, David Anderson is gonna give us a market update on livestock. So, John, whenever you want to start,
okay,
it's all yours. Okay,
thank you. Morning, everybody. So I'll start my 10-minute segment with this. The blue line that you see there is the 2022 related price series. It's the March 23 ICE cotton, and the red line is next season's. It's the December 23 contract. Following the same paths, pretty much, kind of historic rises and falls several times within the season. I'm going to touch on this several times. The price strength that we've seen in the past year, this rally and that rally, were attributed. I'm going to attribute them to concerns about a small crop, concerns about lots of abandonment, concerns about how dry it was. And then these price collapses, that one and maybe the present one, are associated with fears of weakening demand because of stagflation and the effect that higher interest rates is going to have on consumers' pocketbooks, making them cut back on the things that they can cut back on, which include, apparel, durable, new apparel purchases, because you don't have to make those. Unlike gasoline and food, it's one of those discretionary things. So we're in a tug of war where, when it comes to the old crop supply and demand variables, they're summarized in this last column here. And the same tug of war is going on. Everybody thought this is 14 point something million bales, and that's USDA's current guesstimate of how large the U.S. crop, the 2022 crop, is. Now, I got to tell you, everybody thought this number was going to go down. They thought it was going to go down last month, and USDA raised it, and USDA raised it this time, citing lots of bales coming in from Georgia and from the Mid-South and places like that. Now, there are a lot of people, especially out in West Texas, who are thinking, no way, no way, friend. Y'all just need to come out here to West Texas and see how few bales there are. And that's a fact. It's a record, not pretty close to a record low production for Texas. And, next month, which is a little late, but next month they may cut a few 100,000 bales off of this number. Maybe it'll be 14.0, or maybe it'll be 13.8, but I don't think it's going to be a number that's going to cause another huge rally in March or May futures. I think the expectations of low stocks, of low production, are already baked in. And if we never get them, if we don't get a serious cut on the production side, I think the market's going to take that badly and decline, because I think it's already baked in. The other side of the tug of war is the demand side, in which there's 2.2 million bales of domestic use, and that went down compared to last month's estimate. They cut it 100,000 bales because things are kind of weak. And as a matter of fact, I understand that there's a hiatus on U.S. milling. They're shuttering a number of U.S. mills just because there's the demand isn't there, and they're cutting back. So that's going down. The other reason that went down is because world mill use went down 3 million bales compared to November's estimate, and that's reflected in, first of all, we don't have to export as much, so they cut the export number, and they cut our own mill use number. And that's, again, that's the other side of this tug of war, is the weakness in demand. So you've got, we could have short supplies pulling up on prices, or weak demand pulling them down. And this month anyway, the weak demand sort of won. So we'll see what happens in the future. But I think this year's, like I say, the tug of war is going to play out, and it's kind of coming to an end, and the focus is on next year anyway. So let me focus on next year. We're still dealing with an issue of having very few planted acres planted next season, and that's because the price of cotton, which is reflected by the December 23 price, is really low relative to competing crops. I've got corn up here. This is new crop corn, which dipped below $6. But the ratio of that to that is still historically pretty high. This translates to the scale down here, and 7.68 is way down here. And if you map that against planted acres, historically there's a nice tight relationship between how many acres of cotton get planted and what that corn cotton price ratio is. And there's obviously other price ratios we have to pay attention to, like soybeans, peanuts, and wheat. All of those, or at least wheat, is favoring fewer cotton acres being planted too. So, but just looking at the corn chart, it would suggest only around 9 million acres planted, which is historically pretty low. But that's what it's shaping up to be, unless there's a huge rally in this number between now and February 1st. And, maybe there will be, but the things I could think of that would cause a huge rally would probably also affect the grain complex. So I don't know that cotton's going to catch up relative to these competitors. Anything can happen, but this has been going on for a while, and the market just hasn't been favoring the planting of cotton. The market's been signaling the signal to cut back on cotton acres, and so they'll cut way back on them. In the Delta region, in Georgia, they had a good year in Georgia, and some farmers may do the same thing, plant the same amount of cotton that they planted last time because they did okay. But it's hard to ignore really good prices for peanuts and soybeans and corn. So again, we'll have to see. And out in West Texas, I hear all kinds of things. They planted a lot of wheat. It's come up. It's rained a few times. The price of wheat is really good. The insurance price of wheat is really good. And for that matter, they could plant grain sorghum in some places and insure it, and it would look better than it's looked in a while. So we may be, Texas overall may be down 7, 8, 10%, which is, that happens. And this is one of those years that we're coming into where it may happen again. Now, if that happens, and if it continues with dry subsoil moisture, then the upshot of that is we may have, tight supplies on one side of that tug of war. The tug of war may continue. We'll have tight supplies, and that means we'll be in a weather market, and the market will be reacting to planting reports and weather reports and what have you. And at the same time, the market will be kind of looking at the other side of the tug of war at, what's the pace of exports and how's the economy going and what's consumer sentiment doing. And this will be playing off against this, and it'll be well into next year before we know how those variables are shaking out. So anyway, the milestone reports are going to be important, particularly the planted acreage reports. So you start hearing about that at Beltwide, and then in February, and again in February, and then at the end of March. So, if there's a possibility for either rallies or bad reactions, it'll happen probably around these milestones. So something to pay attention to. And that'll wrap up everything I had to share. And that's my 9 or 10 minutes. So let me get out of, push the wrong button. Let me get out of here. Stop sharing. There we go.
Thank you very much, John. That was great. If you have any questions for John now or later, John, are you planning to stay?
I'm going to hang around. Yeah.
He's going to hang around, so you can ask him later if you want, or if you want to write that question on the chat, and I will read it afterwards. Okay. So, Mark, are you ready?
I am, Pancho. Appreciate the opportunity to be with y'all this morning. Can you see my slides okay?
Yes. Yes,
great.
Perfect.
I'm going to touch on many of the same topics that Dr. Robinson just mentioned on, with some implications and application for our grain markets. A lot of interesting movement in prices over the last several weeks. Again, this chart just demonstrates kind of how we've gotten where we are in these still relatively high grain prices, even though we're down considerably from where we were at the peak in the wheat and the corn and the sorghum markets following Russia's invasions of Ukraine. It's interesting to note, where are we compared to a year ago and pre-invasion levels? Wheat, we've fallen about to the levels that we were at this time a year ago and before Russia's invasion of Ukraine. For corn and grain sorghum markets, we were looking at $6 corn and sorghum last December, and these are cash prices, by the way, and so we're still well above that, even though we've seen some pullback in these markets. But the factors that got us here: a short crop in the U.S., a short crop in Brazil, and then strong feed grain demand coming out of China. Those are just three underlying fundamental drivers that were moving prices higher over this series of a couple of years. And so I think there's some implications of where we're going to go with prices. I don't know where we're going to go with the Russians' invasion of Ukraine and how that's going to play out, but I think we are seeing more information around what to expect on the production side in the U.S. and Brazil and other major producers. And also, do we have some information around what to expect on the demand side? And that picture is becoming a little more clear as well. So we'll touch on those very quickly as we move through these grain slides. World corn production is down this year from where the record that we set last year. Again, just to put a little perspective, that the U.S. is still the world's largest producer of corn in the world. We're the biggest producer, we're the biggest user, we're the biggest exporter. But yet, if you look over the last 5 to 10 years, U.S. corn production has really not changed very much. Any growth in world corn production over that period of time has come from outside the United States. And so even though our local and production and consumption trends still drive the corn market, it's really a little less so than it was, say, 10 or 20 years ago. We're still the most important, but there's a lot of other factors that are important as well. Compare that to wheat. In the U.S., we produce our 2 billion bushels of wheat, and the growth in that market has been almost exclusively in those foreign production systems. And so if you look at drivers of wheat prices, for some supply and demand conditions locally, the size of the U.S. wheat crop matters. But in the global, broader price driving environment, it's much more responsive and susceptible to things that are going on outside the United States. And so that shapes also what our expectations might be around our price expectations going forward. Demand does matter when it comes to the grain markets as well. And so we'll be watching very carefully the economic expectations for growth, recession. What's that economic environment going to look like in 2023? We're coming out of the COVID-driven recession in 2020. We responded sharply higher in 2021. Things slowed back down in 2022. And so now the question is, we've fallen back from 21 levels. How far do we continue to fall in 2023? Are we going into recession in major economies like the U.S., Europe, obviously with the turmoil and the conflict going on in Ukraine and Russia, impacting those economies over there? And then we'll focus too on those emerging and developing economies around the world. They've typically had growth rates much higher than the world average, or much higher than the advanced economies like the U.S. What will their growth implications be for 2023 as we continue to struggle with high energy costs, the slowdown in economic activity because of the war, and then efforts by central banks to try to get inflation under control, raising interest rates? What's that going to do to the global economy? And here's just kind of a picture of what that's looked like in the United States. We saw back in January of 2021, we started to see the consumer price index started to rise pretty rapidly. This green line is the personal consumption expenditure, less food and energy. That's an inflation measure that the Fed monitors pretty closely to decide if they're going to raise interest rates or not. But it does exclude food and energy, those volatile components. And both those started to rise pretty rapidly in January of 21. But it took about a year before the Fed decided to step in and think we got to get this thing under control. And so they started raising interest rates in 2022. And you can see the degree to which that federal funds rate has gone from virtually zero. And now with a series of 0.75 of a percentage point interest rate increases in 2022, we've gotten that up, ramped that up to a 4% federal funds rate. And of course, that translates to higher interest rates across the economy. But how successful has that been at reining in inflation? And at this point, it would appear that maybe we have seen some decline in the broader CPI, the consumer price index, from 9% down to something just below 8. And we'll get an update on that this week. But yet this core inflation, that's a little sticky. It's much more stubborn. And I guess my point from this slide would be that we've got a long way to go in this battle too. Interest rate increases, consistently higher interest rates, and the impact that will have on the economy and consumer spending and economic growth. I think these are going to be with us for a while. Again, remember where the Fed's trying to get us back to. We're trying to get back to 2%, and we're still, over 7 on the CPI, around 5 on the PCE. We got a ways to go, and so we may slow down the rate of increases from the Federal Reserve, but it's not likely we're going to be backing up, anytime soon if we're not getting closer to that inflation goal and moving considerably lower over the next 3, 6, 9 months. So I think that will have implications for economic growth. And when we talk about economic growth and incomes and why it matters in the grain markets, there's a strong correlation between per capita grain use and income. And these incomes are in the emerging and developing economies around the world, and they're listed there for you. But when those economies started to grow, their incomes increased, people had more to spend, so did the growth in grain consumption. However, in times of short crops and high prices, grain consumption can go down. And we're in a short crop situation, much of it driven by the war in Ukraine. But still looking at a setback this year in production. And if that is coupled with a setback in economic growth and economic expansion, this rebound or return to this rate of increase in grain consumption could stall for several years. So I think we're setting ourselves for a situation where, if weather permits, we could see a more rapid increase in production coming back rather than a rebound in demand. That demand will be hampered or tempered for perhaps a couple of years, depending on the depth of the recession or the economic slowdown in 2023 and beyond. And typically, we could see a rebound in supply relative to that demand much more quickly, and that could put downward pressure on prices moving forward. We talked about how China's feed grain demand was so important in 2020. Look what they did going from 2020 to 2021. They tripled their imports of feed grains from 20 million metric tons. They went to 60 in 1 year. That kind of mattered when we were talking about grain prices. But what have they done since then? Starting to dial that back now. And whether, I'm not saying they're going to go back to the pre-COVID levels of 20 million metric tons, but certainly we're seeing some dialing back in the current environment of their the buying patterns of feed grains and the impact that had on global and U.S. grain prices over the last couple of years. Now, I want to point out very quickly, look at the red portion of those bars, and that is China's imports of grain sorghum. If you compare those to relatively high import levels of 2014, 2015, dropped off for a couple of years and then surged again in 2020, 2021. And then now we're dialing back again, even on sorghum imports, which grain sorghum is such an important, China's such an important export destination for U.S. grain sorghum. We're kind of back to something kind of normal rather than these good export years. And that has a lot to impact on whether grain sorghum, the price of grain sorghum relative to the price of corn. When we see these relatively low export levels, grain sorghum trades at a wider discount to corn. In these high export years, we see grain sorghum trading at a premium to corn in the cash markets. So this has, I think, some direct implications, particularly for the Texas sorghum market, to see these exports potential to China, particularly starting to be dialed back. The stocks to use ratio, the number I like to use is days of use on hand at the end of the marketing year. we're tight. This is the global number. The yellow line is the world less China. And then the US number is here in blue. And just, China holds a lot of stocks, but they don't trade those stocks. So tradable corn, if you look at the last time we were this tight in our carryover numbers, yeah, you're going back to 2011, 2012, 2013, record high prices and very tight supply levels. And so we're in that world. And so it makes a lot of sense fundamentally why prices are trading. But the current expectations from USDA are that we may be moving for 2023 back to a 42-day carryover. And coming back from any number below 40 in the corn market, that's a very price sensitive area. Trading below a 40-day carryover in corn, that's where we're in this very high price environment. We get back on the other side of that 40-day threshold, and now we're down to some of these longer term, longer range prices, down that $3.50 to $4 level. So I think that'll be the question to watch moving into 23, either supply or demand. Both of those will impact what that carryover number looks like in our corn markets. For wheat, same kind of picture. That stocks to use ratio is lower, whether US, world less China, it's tight. The world situation is very tight. And again, you've got to go back in wheat even farther, back in 2007, 2008, to find stocks to use ratios that were as tight as they are, as we're seeing right now in the wheat market. And again, that was when we were setting record high wheat prices. So fundamentally, yeah, it makes sense that prices are where they are right now in wheat. For a production outlook in the southern high plains, we're still stuck in this La Nina weather pattern, with the expectation or the forecast that by the time we get to January, February, March, perhaps we'll be moving out of the La Nina zone into neutral conditions. And right now, the long-term forecast is perhaps a return to even El Nino by the time we're planning next 2024 wheat crop. But if the wheat can survive this winter, the growing conditions coming out of January, February, March, April, at least perhaps we'll be out from under the drier and warmer conditions that tend to come along with the La Nina weather phenomenon, and perhaps something a little more normal consumption of weather outlook, which would be favorable for wheat production. And that would certainly mean if we see more wheat acres this year, if we see better weather conditions in the spring, you'd expect to see a bigger wheat crop in the US in 2023. And if we do that, perhaps we're now turning that days of use on hand around, going from about 111, 112-day carryover back up to, say, 124 days in USDA's long-range projections. Again, that's downward pressure on prices if we were to see that kind of production and yield, and then combine that with perhaps a slowdown in demand on kind of a global scale. Again, those are factors that would begin to shape a stocks to use ratio that would begin to increase for 2023. So I think we may be looking at a turning point out of this current marketing year as we're looking at the grain markets for our price expectations. I think it will be still relatively high prices historically, where, if you go back to where even we were a year ago, those are still really good prices, but we've got really high cost as well. So being as efficient as possible. And I think there's a key management mindset that has to go around with these high prices and high cost. It's a time to be efficient with cost, not cut corners with cost. And so be very aware of costs that we're trying to manage, and to the challenge, of course, is reduce those costs as much as possible. What are those costs that will impact our production levels and impact our profit margins? Are we giving up production when we attack some of those budget issues? So again, efficiency rather than corner cutting, I think is very important to make our enterprise plans for 2023. I think corn acres and wheat acres are both going to be up, see our stocks use ratios higher, and that will put moderate decreases on prices. As tight as stocks are globally, I don't see a collapse in prices by any means, but yet the pressures are there from the demand side and the supply side to start putting that pressure on prices moving lower as we look into 2023. So Pancho, that's what I brought to share with y'all today. Be glad to take any questions or comments as we move through the program, but thanks for the chance to be in with y'all.
Excellent, Mark. Thank you very much. Great presentation. Any question for Mark? If not, we keep going with David Anderson. Mark, you probably need to stop sharing so John,
Yeah.
so David can start sharing.
I'm trying to find that button.
Oh, you got it. You got it. I don't
Okay.
know how you got it.
Good, thank you. I'm
Well, David, whenever you want to start.
Okay, you see those okay, Pancho?
Yes, they look
Great.
great.
Well, thanks for doing the legwork to organize this, and thanks for everybody who's on with us. I'm going to do a couple of livestock things that I think will go along with some of what Mark said pretty good, I hope. I thought I got sort of a shotgun approach here. I want to hit about 3 different things, and I'm going to start with beef cow slaughter. You know, that's been a running thing all year, with every week of the year being ahead of or larger than where we were the same week last year. What I would point out is, you know, we sort of hit our peak. Again, this is nationally. Several weeks ago, we hit almost 85,000 head. Since then, it's sort of backed off. You can certainly see the big decline. You know, our holiday week here. We'll see how this rebounds as we get this data. There is a little lag in the data as well. So we'll get some more and see how we rebound up. But what I would point out is that we're a lot closer to a year ago. It might give us some ideas. Not that herd contraction or culling has sort of ended, but I think we've slowed down a little bit, got a little closer to a year ago. And to the point where maybe we've done a lot of the hard work of culling already, and now we're going to wait and see where we are. And so I think in terms of cattle numbers, that would be pretty welcome, but it doesn't change the story that we're going to see when the data comes out at the end of January on the cattle herd that beef cow numbers are way down from where they were. I think at least 3% or more. But we'll see some more when we get there. But certainly I think that slowdown or that difference to a year ago is pretty important. But we're still sending more to market than we did a year ago. So I think that's kind of just an interesting update. Do we see some declines, some slowing down? I think we do. Maybe some slowdown in culling. On kind of the feedlot side, I want to hit 4 or 5 slides here on feedlots a little bit, particularly given what Mark said about, corn prices, where they are and why. If we look at feeder steer prices, number one, Southern Plains, 750-pound steers, certainly prices well below a year ago. If we looked at lighter weight ones, above a year ago as well, but a little more volatility in them, particularly driven from the feed cost side. But a couple of things are going on here. You see our prices over the last 5-6 weeks increasing a little bit. Really, it's the time of year that we have relatively fewer of these heavy animals. I think we continue to see good demand from feedlots, driven by profitability, but driven by expectations of higher fed cattle prices next year and high fed cattle prices right now. And so that effect on kind of right now profits of cattle that are finishing and getting more than $1.50, $1.55, $1.56 in the recent fed cattle markets, suggests some profits that are pulling those prices higher, keeping those prices up. And again, this is before we start getting into tighter and tighter supplies as our cow herd shrinks more and more over the next year to 2 years to 3 years. So really, I think that's a good view of why we see generally higher calf prices and feeder cattle prices over the last few weeks. I want to share with you, I think, an interesting data set that's got a pretty long history to it. It's a survey, a monthly survey of some Kansas feedlots. And it's broken out by steers and heifers. There's a couple of things I thought I'd pull out for this week's little presentation as we think about what's going on at this segment that's buying our calves, that are pulling these feeder cattle prices higher. Well, the first one I want to show is feedlot closeouts. So of these feedlot pens that are going to a packer, what are the feeding costs per hundredweight? Now, again, this isn't a total break even, it's feeding costs, but it's pretty easy to see this run up in feeding costs that go right along with the price data that Mark was showing for certainly for feed grains. feeding costs well above a year ago. We've crossed $135 a hundredweight, $1.35 a pound just in feed costs. So again, as we see corn prices and higher, the protein side of things higher also, we certainly see these feed costs rising. Which certainly has contributed to some pressure on feeder cattle prices earlier in the year and into last year. As those feed costs went up, it takes some out of the calf market, so that we still have higher feeder and calf prices than we did a year ago in the face of this kind of run up in feed costs. I think is a pretty positive outcome for the live animal side, that we've been able to see those higher prices. Again, the fed cattle prices remain high. They've been increasing. Some profits are there. And so, feed costs by themselves aren't the whole story. But I think it's an interesting set of data. It gives you a notion of how feed costs are moving compared to a year ago and the 5-year average in this data. So the other one I want to use out of this data is of these pens that are closed out monthly, the amount of feed that we're feeding in dry matter per pound of gain. And so what I would argue is, if we looked at this over a long-term period of time in this data, we certainly see an industry that's become more efficient. We have cattle that are producing a pound of beef with less feed, and that long-term trend is there. Yet within the year, we see some pretty interesting seasonality, certainly in the springtime or early in the year, higher feed per pound of gain. And common sense will tell us, well, gosh, if nothing else, it's cold, and so we're using more of that feed to produce energy rather than put weight on. But within this the higher feed costs, we also have some more efficient use. We're using less feed in some months than we did a year ago, but less on a 5-year average over the last 6 months to produce that beef. And so I think it's an interesting set of data that suggests, heck, you look at this, we actually had a month that was under 6 pounds of feed per pound of gain. Long term, a much more efficient industry using this feed more efficiently. And a tribute to to ranchers too, that are producing cattle that are able to get these kinds of gains. And that's been a long-term process, but something that I think we would all expect would continue as well. So I think that's those two slides, pretty interesting set of data, a little different look at some feedlot data than maybe we would normally talk about. I mentioned profits to feeders. I think I used this chart last month as well, but I wanted to look just briefly at sort of a rough measure of profitability. Feeding 750-pound steers, selling them at their finished weights. Last 2 months have been profitable. The last estimate here was October, but the last 2 months have been profitable on those closeouts. Certainly high and rising fed cattle prices compared to the purchase prices on those feeder cattle. And even in the face of higher feed costs, we've turned a couple of profitable months, and I think that's helping us certainly on the calf price side and feeder cattle price also. I thought I'd jump to kind of do a little forward-looking thing at commercial beef production. This is quarterly. The red bars are 2017 through 21, that 5-year average. The dark blue is 22. Light blue is 23, and the brown one is 24. So, as we sort of start matching up declining cow herd, fewer calves born in the spring, we get to that we think about from the time those calves are born, roughly 20 months to the time that they go to a packing plant. So declining cow numbers leads us out there where we're already going to talk about 24 and 25 in terms of beef production. But if we take a look at these, where we've been this year, the first 3 quarters of the year, quite a bit more beef production compared to a year ago, or compared to the 5-year average, is what I mean. And finally falling below that here in the 4th quarter. Every quarter for the next 2 years out is going to be below the quarter of the year before. We start seeing some pretty big declines in beef production year over year. So we get to looking at that, we're we're at 25 billion pounds by the time we get to 2024. Well, we're going to produce just over 28 this year. So, we're really starting to talk about some pretty sharp declines in beef production going forward based on cow slaughter, heifer retention, or the lack of heifer retention going forward. So I think that's kind of an interesting slide. Gives, here in December, a kind of a forward look at where we're headed in beef production. I want to use this one. This has been a controversial one. This is the live to cutout spread. This is the chart we usually talk about. Lots of people use this to talk about packer profits. And it's really not profits. It's a gross margin, the selling the beef minus the purchase price of the fed steer. And so how much money is left there that you're going to pay all the cost of packing. But, I decided at the risk of lots of risks of using this chart, I decided to use it anyway. Look at this dashed line for 2021. Certainly these really high months, over $950 per 1,000 pounds. Some really astronomically big numbers that I think we've talked about a lot. Lots of folks have talked about. And really simply what I want to point out is look at the decline in this. If we look at this blue line, which is where we are this year, we've actually dropped below the 5-year average. One reason I use this is I've seen in the last couple of weeks in some popular press, there are other analysts who have estimates of packer profits. Those have actually been in the red. So you may see some things in some popular press about packers starting to lose money with wholesale beef prices, the cutout that it continues to decline, fed cattle prices that are going up. I think it's fair to say that those margins have been squeezed quite a bit, and there's some good analysts around that have some data that would suggest actually some negative or losses on the packing side as we see this decline. Longer term, the pressure will be on packers because we have fewer and fewer cattle, tighter supplies, yet the demand for beef has been there. It has continued to hang in there even with high prices, and so that really puts a squeeze on folks there in the middle, and that happens to be packers this time around, and so we see this decline. So I thought it was worth showing that just to kind of think about that a little bit, particularly given what I've seen in some popular press articles. I got 2 more slides, and I'm going to switch species on us. One of the things I haven't talked about as we've done these, obviously we spend a lot more time on cattle. Not many of us are doing a lot of hog stuff, but I decided to do something on the hog market just to get an idea. Some of you may be involved with some kids that got some hogs, or we get to fairs, we get to things like that, but also what's going on in this broader meat market that we're all in as well. Using a national weighted average carcass price for hogs, net of some carcass premiums and things like that. We've had some pretty high hog prices this year, and certainly the last 5 months have been above where we were a year ago. We certainly see this really pronounced, more so than on average, pronounced seasonal increase in hog prices. We're coming down seasonally right now. Really, we've got higher prices because we've got less hog production. We've had some struggles with profitability. That's led hog farms to cut back. I think we certainly have some disease problems going on in the U.S. and a rising trend of sow mortality, which is really limiting these efficiency gains and profitability gains that we've had in the industry for a long time. So it's leading to a lack of profits. It's led to really fewer sows being held back in the herd, fewer farrowings than a year before, and less production without those technology gains in not only pigs per litter, but litters per year. That's really preventing the industry from being able to expand looking at these high prices. And so we've got that really tight supplies going on. At the end of this month, there will be a USDA hogs and pigs quarterly report come out reflecting December 1. So again, that's another reason to kind of look at this for a second. I mentioned hog production. Every month this year, I'm looking at weekly average of hog slaughter has been below the month the year before. So when we talk about tight supplies on the hog side, we got tight supplies. And so those tight supplies, I think, are going to be with us. You know, we're to the point where we're pretty close to a year ago in terms of production. You know, I would look at next year, at least the first 3 quarters of next year, we'll probably have less hog production, less pork production than we did the first 3 quarters of this year even. So again, tight supplies, high feed costs, really a lack of profits, really constraining the hog side. And also, I'd say the first 6 months of this year, we certainly saw less exports. And much of the growth in pork production in the U.S. over the last 25 years has been directed at the export market. And so when we see a hiccup in exports and we're not getting that stuff moved, it certainly leads to some lower prices. So, Pancho, that's my last slide. I'll see if I can get out of this.
Great, Don. Sorry, David. Thank you very much. Let me stop recording here.